Why do you say earnings will really determine the trajectory of this going forward?
Good question, and thank you for having me. So I think the first question is, if you look at what the channels obviously for returns are, it's valuation and it's earnings. On the valuation front, our view is that we are fairly fully valued. Whether you break it up into big tech or rest of tech or rest of S&P, we think, in fact, that that being a channel for returns is limited. But what we did see in the first quarter earnings was big tech earnings accelerated even further, not just realized, but forward estimates. But finally, for the rest of S&P outside of tech, we saw revisions moving in the right direction. So big tech moved from forward guidance of around 10% to 20%, so it's phenomenal. And the rest of the market moved from around 2% to 5%. So finally, we're beginning to move in the right direction, even though the delta between the two is massive.
I guess when you're talking, I'm thinking why? Why is some of the profit expectations increasing at some of these smaller or more leveraged companies? Rates aren't going down. The consumer, people say, is weakening. We got some weaker than expected economic data pretty consistently over the past couple of weeks. Why are earnings actually managing to increase, at least expectations, for some of these smaller, more highly leveraged to the economy companies?
Sure. Just to clarify, it's not about small caps. It's the rest of S&P. Right? Because S&P itself is so concentrated and so bifurcated, so we don't even have to go till small caps. In fact, our view has been, we've been negative on small caps for over a year, and we have not changed our view. Even though this whole broadening trade has been the most popular trade on Wall Street for 9 months, and we've been on the opposite side. We still remain on the opposite side. So we still think it's large caps or small caps. So to answer your question, I think it is all about what you figured out from first quarter earnings, right? And there, for the first time, not only did we see margin continue to improve for the third quarter in a row, but for the rest of S&P also it incrementally nudged in the right direction. And so, our view always was the last 3 quarters, the final improvement in margins was all concentrated in tech. So even now, it is dominantly concentrated in tech. But there are some glimmers of hope. But that said, our view is that we want to wait and watch for the broadening to take place. That's why we remain kind of skeptical on the borderline. And that is because it is just 1 quarter. Right? And we are beginning to see cracks in the consumer, and which means that companies which took advantage of COVID as a one-time opportunity to raise prices without fear of a competitive reaction, now are finally facing a situation where final demand can be moderating a little bit, and consumers are becoming more careful about where they spend the dollar, marginal dollar at least. So we think that does translate into some sort of margin pressure. And surprisingly, I think where the equity markets need to pay attention is that compared to historical, the way the market reacts, some of the more defensive areas in the market are the place where there is still some margin pressure, especially staples, right? And so if things were to go wrong, the kind of protection expected from staples may not materialize. So this is a fairly complex market. Like say, highly concentrated and yet very high dispersion. It means it's a stock picker's delight, but they are struggling to outperform the market. Less than, I think, 20% of funds are actually outperforming the market. So this is a tremendous challenge.
I was going to say, Venu, why would I buy anything other than a passive S&P 500 fund right now? Because it will capture all that upside of the larger companies who keep getting larger. And presumably, if you're an active manager and you're outperforming, you're even more overweight those companies. So how does an active manager even try to get fund flow in a time like this?
That's an excellent question. So to give you a sense, we've been positive on big tech since the fourth quarter of 22. And we haven't changed our opinion since then. And to your point, when we get asked this question about asset allocation, in fact, it's the question we had just recently. And this is what I told them. And even I'm not an asset allocator, right? But I'm just being intuitive in terms of, right? You can have the market exposure to big tech, right? And by the way, correlation between those stocks is 40 to 50%. In other words, you can nuance your opinion within those 6. The correlation of big tech to the rest of the market is only 20%. It means dispersion is very high. You can go and look outside, right? So I think it's the way you construct your portfolio. And then on the front end, on the cash market, you're still earning 5.35%. So I would say put 20% of your cash in front end, keep rolling it, because even if rate cuts come, you're still going to be in the 4s by the end of next year, right? Maintain your market exposure to big tech and play around on the margin a little bit, and then you're left with roughly 40%. knock yourself out by trying to be an active picker and then go and find the value because dispersion is allowing you to do that.
First of all, I love that you still see cash having a place in a portfolio.
Absolutely.
Because there's lots of people who have come on, I know, this program and
Yeah.
have said it's time to look away from that.
Mainly credit folks.
Mainly credit,
Yes.
yeah, so maybe a tiny bit of book talking. But okay, with all of this, you mentioned things like staples are no longer your safety. So where do I get safety? If I am not just buying the S&P 500, I want to turn to an active asset manager. Where should I be finding a safety trade that can be my ballast in an equity portfolio?
So let me give you one approach of doing that. So that's exactly what we tried to answer recently, saying that you can't get stuck in 6 stocks, right? It is getting scary because concentration by any metric you look at is on the extremes. So one approach we looked at was, why is big tech doing very well? So on a host of fundamental metrics, they're killing it. So we said, how can we try and look outside in the 494 stocks and try to approximate those levels of financial metrics? So you cannot replicate it, but you can try and come close to it. And if we take a diversified approach, we actually managed to pick about 50 stocks in the rest of the 494 stocks. And our hope is we're going to rebalance it every month and see how that's doing. So I think this is not a sector-oriented market, because traditionally in asset allocation, or 80% of returns come from the sector, but we think that's not the kind of amount. You want to wear a growth hat, a quality hat, and then scour the market, keep it diversified because you're trying to avoid concentration, but keep your exposure to those big 6, keep your exposure to to cash, and then play around in the middle with that 40-odd%.
Your notes reflect some conviction you have. I want to ask you about the presidential election. Lori Calvasina was talking about this paralysis investors may feel. But you have conviction on potentially what we may see after November. How do you prepare equities for that?
Well, you cannot prepare for it, right? Because the point is that it's a closed election. It can go any way. But you can just look at history to get some sense of how the market has behaved. So interestingly, historically, if you look at how markets behave, returns during election years actually behave less than the prior years, in normal years. Second is, when Democrats win, typically we have found that in the first year, returns are better. But on the other hand, when Republicans win over a 4-year period, returns are better, right? So I think the biggest thing right now is focus on what policies they're touting and try and see what the impact on the market is. That's what we tried to do recently. So if you have a Trump regime, for example, and if they follow up on some of the tariff discussions where 60% on China, 10% across the board, rest of the world, and we assume that what if the world also retaliates? They will, right? So they're not going to be sitting and taking tariffs from our end. So that impact on earnings, we think, is going to be almost 4% in aggregate. On the other hand, if you have taxes, and if Democrats come and there's a blue wave, which we think is highly unlikely, and taxes somehow go to 15%, there's a tailwind of almost 3.5% to earnings. But you flip it and you say Democrats come and they raise taxes to 28%, then your hit to earnings can be almost 7.5% based on taxes going up and the taxes on buybacks. So I think it's a mixed bag. If you have a red wave versus a blue wave, but our view ultimately is that it's going to be a divided government, and that will act as a balance from some of the more extreme measures, and the market will do fine. Politics, as we talk a lot about it till we enter it, and then we move on with our lives.